Imagine two people. Both walk into the exact same bank. Both wear ordinary clothes. Both ask for a loan. The first person is politely told, "We're sorry. Your application wasn't approved." The second person walks out with a private banker, a lower interest rate, a premium credit card, a personal investment advisor, even free airport lounge access. What happened? Did one person know someone inside the bank? Was one person simply lucky? Not necessarily, because banks don't see customers the way people see each other. They see something else: risk, assets, income, cash flow, potential. Today we're going to explore what actually happens as your wealth grows, and why the same bank can treat the same person very differently at every financial level. Stage 1. When you have almost no wealth. Imagine you're 22 years old. You've just started your first job. You have $800 in your checking account. No investments, no property, no credit history. You walk into a bank wanting a loan. From the bank's perspective, they know almost nothing about you. Will you repay? Can you repay? Nobody knows. Banks make decisions using probabilities and with very little financial history. You're considered higher risk. This doesn't mean you're irresponsible. It simply means there's very little evidence yet. Banks don't lend based on hope. They lend based on data. Stage 2, building trust. Fast forward 5 years. You now have a stable salary, regular deposits, an emergency fund, a good credit score. You've used a credit card responsibly. You've never missed a payment. Suddenly, banks begin contacting you, pre-approved credit cards, personal loans, higher limits. Why? Because you've become predictable. Banks love predictability. You're no longer an unknown customer. You've become measurable. Trust in banking is often built one payment at a time. Stage 3, the first 6 figures. Now imagine your investments reach $100,000. Your salary continues increasing. You own a home. Your cash flow is healthy. The bank now views you differently. Not because you've changed, because your financial profile has. You may qualify for lower mortgage rates, better refinancing offers, higher credit limits, preferred banking services. Notice something. The bank isn't rewarding success, it's pricing risk. The lower the perceived risk, the better the financial offers often become. Stage 4, when money starts working for you. Now imagine your investments reach $500,000. Your portfolio produces income, dividends, interest, capital gains. The bank notices something important. You're no longer relying entirely on your paycheck. You have assets. Assets change everything, because if income stops temporarily, your investments still exist. From the bank's perspective, you've become more resilient, and resilience reduces risk. Stage 5, becoming a high net worth client. Now imagine your net worth reaches $2 million. Something interesting happens. You stop chasing the bank. The bank starts chasing you. Private banking invitations, dedicated relationship managers, exclusive investment products, estate planning, tax specialists, business financing, priority service. Why? Because wealthy clients often generate more business. Mortgages, investments, insurance, business accounts, trust services, one relationship, can produce revenue for decades. Banks don't simply lend money, they're relationship businesses. Why rich people often borrow more. Here's something surprising. Imagine someone has $5 million invested. Could they buy a house with cash? Absolutely. Many don't. Instead, they borrow. Why? Because their investments may continue earning more than the loan costs. Imagine borrowing at 5%, while investments historically average around 8 to 10% over long periods. That difference can potentially create additional wealth. Debt isn't always bad. Expensive debt can be. Productive debt can be a financial tool. Understanding the difference changes everything. Actually, the wealthy rarely sell their assets. Imagine needing $500,000 for a new business. Most people would sell investments. Many wealthy individuals instead borrow against them. Their portfolio remains invested, compounding continues. Meanwhile, they access liquidity. Banks like this arrangement too. The investments often serve as collateral. Lower risk, lower interest, better terms. Money begins opening financial doors most people never knew existed. Many people think banks want wealthy customers. That's partly true, but there's something even more valuable. Reliable customers. Someone earning $80,000 who consistently saves may be more attractive than someone earning $300,000 who spends everything. Banks analyze cash flow, payment history, debt ratios, assets, consistency, not just income. Financial behavior often matters more than financial appearance. Here's what this episode isn't saying. Banks don't determine your worth. They calculate financial risk, and risk changes over time. The encouraging part, almost every factor banks evaluate can improve. Saving, investing, credit history, debt management, cash flow, time. Every smart financial decision quietly changes how financial institutions see you, long before you notice it yourself. If there's one thing I'd like you to remember from this video, it's this. Banks don't treat people differently because one person is more important than another. They treat financial profiles differently. The good news is, your financial profile isn't fixed. It evolves. Every investment, every responsible payment, every dollar saved, every year of consistency quietly builds something far more valuable than money alone. It builds trust. And trust in finance often becomes one of your greatest assets. I'm Morgan Vowles. Build small, grow strong, live free. And I'll see you in the next video.